Welcome back into Thimbleberry U. I am John Jagay. I'm joined by Amy Walls from Thimbleberry Financial. Amy, good to be back with you.
Jag, it's always great to be talking to you.
Today we're talking about something that is very, very timely. We're recording this on October 12th, and that is the House tax plan. There's been a lot of stuff in the news here. I feel like it's very easy to have your eyes glaze over as you see headlines fly by or you watch the news at night. I'm hoping you can kind of break this down as far as how it is going to affect our listeners.
Absolutely. That's the goal. And let me address the why behind this.
Mm-hmm.
You know, the Biden plan is the one that's really gotten lots of attention, really since before the election, if we're honest about that.
Yeah.
But the problem is it doesn't seem to have enough support in Congress to make it a reality. So about a month ago, the House put together a draft plan. It was released mid-September. And really, they did this in an attempt to garner more support for the tax changes that they want. So some of the items differ from the Biden plan and some are quite similar. And I also think, Jag, as we're talking about this, just starting out, I think it's important to note that what's in this bill is very likely to change going forward.
It seems that stuff is changing by the week. Absolutely.
Yes.
As we take a step back from this plan, I come back to my earlier question, which is who is going to be the most impacted? And really, I want to know if I should be worried here.
Of course, Jag. So know that, first of all, as I've looked at the proposed changes, I'm doing so from the lens of what pertains most to our clients.
Sure.
All right, which are individuals who work in tech and healthcare. That's what I'm going to focus on as I discuss the changes. You're a business owner.
I am.
So there are changes that affect business owners and corporations, but I'm not as well versed in those just because they don't impact our clients to the same extent. It really appears, though, that most of the changes are for people whose income exceeds $400,000. And I think that's the bottom line.
Okay, so that's not me yet. I hope it's me someday. But it does affect a lot of your clients. And let's sort of dive into that. What are some of the changes that are going to affect those high-income earners?
Yeah, there's some tax bracket and capital gains changes in the proposal. So the proposal includes increasing the top federal tax bracket to 39.6% for single filers with taxable incomes above $400,000 and joint filers with taxable incomes above $450,000.
So I'm going to pause for a second there, Amy. So what that means is once you hit that number, 400 for single, 450 for married, any income above that then would get taxed at that higher rate of 39.6%.
Exactly.
Okay.
You've got it. On the capital gains side, the proposal includes increasing the top long-term capital gains rate from 20% to 25% for that same group of people. Now, I think it's important to note that 25% is still much better than 39.6%.
Yikes. Okay.
And if this were to go through as written, it's also important to note that that long-term capital gains rate became that rate on September 14th, 2021. So people have to be aware that this could go through December 31st, and anything they do between September 14th, 2021 and December 31st, 2021 may actually get that 25% long-term capital gains rate.
Retroactive back to a month ago when we were recording this. That's an important point to make. Okay, what else?
This same group, generally the same group, I'll explain in a moment, would not be eligible to execute any Roth conversions. We've spent a lot of time talking about Roth conversions.
We have.
And I said it's roughly the same dollar figures, and that is because in this proposal, the exclusion for Roth conversions is not based on taxable income, but something new called adjusted taxable income, or ATI.
Okay.
And I'm not going to go into the details on that because if somebody's really needing to dig into that, they really need some specialized advice. They're worrying about it. So ATI is a new deal and just something people need to be aware of. So it's not exactly taxable income. It's this other figure.
Got it. Okay.
There are more high income earners, those over that ATI threshold of 400 for single, 450 for married, filing jointly, and who are also high net worth, which is being categorized as retirement accounts in excess of $10 million.
Okay.
Will be subject to increased required minimum distributions.
Really? Okay.
Yes. This is huge, Jag. Huge. Those increased required minimum distributions are really, really big. When I say they're big, the RMD, this excess RMD, right, will be equal to 100% of total retirement account balances in excess of $20 million. Plus, so what that just said is you can't have anything over 20 million. You have to pare it back.
Wow. So they're going to make you take it out and to get down to the 20 million if you're over that. Okay.
Yes. Plus 50% of total retirement account balances in excess of 5 million.
Those are really big numbers.
Really big.
Jeff Bezos is quaking in his boots right now.
Very likely. That same group would also be prohibited from making additional IRA contributions under the proposal. Now, they're not prevented from contributing to an employer-sponsored plan, but they can't contribute to an IRA. So additionally, outside of those excess required minimum distributions, those excess distributions also come from Roth IRAs before coming from other accounts. And those Roth IRAs from our prior podcasts, as we've talked about, that's tax-free money into the future.
Wow. So I'm processing this as you're saying this, Amy. And I'm thinking to myself, why would they say Roth IRAs first? And now that you're explaining it, the idea would be you got to get rid of that money first because the government's not making any additional taxes on that money because you've already paid the taxes going in. So you have to empty that out first, and then you can start emptying the stuff that you're going to have to pay the taxes on. In other words, the government is going to want to keep getting their taxes on the non-Roth money while you have to take the Roth money out first. That's really interesting and huge.
And it creates some estate planning challenges.
Oh, yeah.
For folks who are planning on passing that Roth IRA money onto their kids tax-free.
You have really opened my eyes today, Amy. There is a lot of stuff on the table here that is worth paying attention to.
Yes. Now, average Joe doesn't have to worry about that, right? Because these are really big retirement account balances.
Right. I do not have $10 million in a retirement account, but there probably are some proposed changes here that are going to apply to everyone, you, me, and all of our listeners, right?
There are some. Yep. So these changes primarily aren't income or asset-based. So, Jag, we've spent a lot of time on podcasts, as I mentioned earlier, talking about Roth conversions. Mm-hmm. And if this goes through, I think this even has potential with drastic edits to go through, is the backdoor and mega backdoor Roth strategies we've talked about would be done at the end of this year.
Ah.
It would no longer be an option. So that's changing a lot for our clients if that happens.
Right. And if you're not familiar with the backdoor Roth or the mega backdoor Roth, go back and listen to our previous Thimbleberry U podcast because we explained it in previous episodes.
Yes.
What else?
For crypto investors, there could be a big change coming, and that is that wash sale rules would apply beginning January 1, 2022. So basically, if you were to buy a stock and sell that stock to take the loss, and then you buy it right back. Mm-hmm. Okay? It's called a wash sale. You're selling it and then buying it back, so it's a wash. And crypto investors haven't had that rule and regulation.
Right. That wash sale rule for our listeners is you've got to wait 30 days, right?
Yes, correct.
And that has not applied to crypto up until this point.
No, it has not. And so there's a lot of crypto investors that maybe have crypto at a loss, or they're switching between forms of currency that are essentially the same, or that this wash rule could apply to. That
is really interesting. Okay. Any other changes for all of us listening?
Yeah, well, I'd group this into all of us, but it's for those with the kiddos. Mm-hmm. It does also have an income limit of $500,000, and that is the child independent care credits would be made permanent.
Okay.
And the amounts are 4 times bigger than before.
Oh, really?
Mm-hmm. And the $500,000 limit is basically you could qualify now if your income is up to $500,000.
Okay. I don't have any kids myself, but friends of mine that have kids, that child care credit has been a big deal for them in the last year or so. So that's worth knowing as well. Amy, what isn't in the plan? We talked about what is in the plan. I know a lot of stuff has been bandied about on Capitol Hill for the better part of 2021. What actually is not in the plan, as we record this on October 12th?
And I'm glad you brought up that date again, because these things could definitely change. They did not include any elimination or limitations on step-up in basis in the plan.
That was a concern. Can you very quickly give us a reminder on what that means?
Absolutely. So just like earlier, we were talking about the retirement plans and passing that to children tax-free. So when you buy an asset, actually, I'm just going to use a home, for example.
Sure.
Okay, let's say mom and dad own this home. They've both now passed away and the house is worth $500,000. And let's say they bought it for $50,000 40 years ago. Mm-hmm. The parents had a $450,000 gain.
True. Okay.
On the house. So let's say before the second death, it was sold, they would have realized $450,000 in gains that isn't taxable because it was their primary residence. And the same example applies to stock. So now the kids inherit the money, or they inherit the house. They aren't the primary owner. They technically need to pay gains on the $450,000.
Ah, okay.
But assuming this house is held jointly, at the second death, there's a step up in basis to the value on the date of death. So now the kids are inheriting the house with a basis of $500,000. If they sell it right away and they don't sell it for over the $500,000, there's no gain to pay tax on.
You don't have to pay the gain on that increase in worth of $450,000. Got it. Okay.
Yeah. So Jeff Bezos, again, good example. As he passes that money on to his kids that's not inside any type of plan, retirement plan, his Amazon stock, he's got it for pennies as basis. When his kids inherit that, they will get a step up to the current value of Amazon.
Okay. For approximately $1 gazillion. Got it.
Exactly.
Those numbers aren't exact, by the way.
So right now, there's no limitations on that step up or elimination of it. They're really focused on the retirement plans.
Okay, so that was not addressed in the law. What else not in the plan?
Social Security is not addressed. So we all know there's some issues with Social Security. That can be many, many podcasts, but that's not addressed here. So we could see changes later on with that. And the last big thing that jumped out is something called SALT deductions. Mm-hmm. Here in Oregon, we definitely experience this. It's state and local tax deductions. It's what SALT stands for.
Okay.
Basically, this came about under the Trump's Tax Cuts and Jobs Act.
2017, right? Okay.
Mm-hmm. And what happened is state and local tax deductions were capped at $10,000. And so for people who live in states that have an income tax, they lost a lot of their deductions.
Okay.
Okay. And so they're paying more in taxes. So, it's been thought that that is likely something that would get addressed. And as of right now, it's not included.
So just to put a fine point on that, say you live in a very high state, like, for example, New York, and say you paid $20,000 in state and local taxes. Currently, you can only deduct $10,000 of it. Do I have that right?
Correct.
Okay.
So, which means those folks' federal taxes went up.
Oh, because they weren't able to deduct everything they paid in state and local taxes for states and areas that have high taxes.
Yes.
Got it. Amy, there's a lot of moving parts here. Again, in 15 minutes, we've really only scratched the surface here because stuff is changing, it seems like, by the minute in D.C. And it's hard to keep track of all of it, but I think you've given a really good outline of some of the key finer points and the big ticket items in the plan as it stands right now. If somebody listening wants to talk to you more in detail about what's happening or anything regarding their financial future, what are the best ways to find you at Thimbleberry Financial?
Yeah, I think the best way to find us is online at thimbleberryfinancial.com. And they can also give us a call at 503-610-6510.
Thank you for explaining a lot of stuff that I was confused about today, and I hopefully the same is true of our listeners. Always a pleasure, Amy. We'll talk again soon.
Thanks a lot.
Registered representative. Securities offered through Cambridge Investment Research, Inc., a broker-dealer, member FINRA SIPC. Investment advisor representative. Cambridge Investment Research Advisors, Inc., a registered investment advisor. Cambridge and Thimbleberry Financial are not affiliated.